people in. Yeah, we'll probably leave it a minute or two for some stragglers, but I'll admit all. So we're going to admit all now. So there we are. Good morning, Andre. Good morning, John. Good morning, Chris. Good morning, Sarah. Good morning, Jasvir. Good morning, Jenny. Good morning, Jim. If you have just if you just joined, if you could go on mute, that would be fantastic, just to cut out any background noise. Thanks, Jim, for the thumbs up. And we'll just allow more people to join. Morning, Chris. Good morning, Pedro. Good morning, Tim. Good morning, Adam. We're admitting all. If you've just joined, if you go on mute, that would be great. Thank you very much. Morning, Adam. Morning, Tim. And we'll just admit Lamb as Wilson as well. If you have just joined, go on mute. That'd be great. Really, really appreciate that. So Jasvir, Penny, if you, Jenny, if you could go on mute, that'd be great. And then we'll leave it another minute, I think, and then we'll start. So good morning, Barry. Good to see you.
Good morning.
We'll introduce Liz as well. For everybody's benefit, Alan, Jenny, Sarah, Evan, everybody, we are recording. So everybody have Jasvir, thumbs up. Jenny, pleased with that recording for posting that on the Paint Playpen website later on today. And we'll just bring another 1 or 2 people in, and then we will get going. Right, okay. Well, good morning, everybody. Welcome to our weekly coffee morning, held every Tuesday at 10:30, with lots and lots of exciting debate and subjects and hot topics. Today, we're delighted that Evan Guppy from the PPF is with us, and Henry Tapper, our chairman, will be doing the sort of hosting of the questions. As usual, A, it's informal, B, it's being recorded, as we all know. C, if you have any questions, put it in the chat or raise a hand and ask a question of Henry or Evan if you would like. So without any further ado, I'll go on to mute and pass over to Henry. Henry, over to you.
Morning, everyone, and welcome to South Colonnades, Canary Wharf. I don't know why I'm here, but I am. And I'm delighted that we've got such a nice group of people on the call. I'm even more delighted we've got Evan Guppy on the call, because I've been looking forward to hearing from the PPF about their experience with LDi for some time. As I think everyone knows, I have views on LDi, which I expressed, and I don't want those views to be rehearsed, because this is not about me. And I'm quite sure that my views will change over time, and quite possibly as a result of this conversation. Evan, can I ask you to unmute? Would you like to just sort of introduce yourself? Give us a little bit of background about where you come from and how you managed to make it to the to the PPF, and we can take it from there.
Yeah, sure. So hi everyone. Yeah, as Henry said, I'm Evan Guppy. I run the LDi strategy and credit strategy here at the PPF. So basically, I am responsible for anything that is a hedging asset that we use to get interest rate and inflation risk in our portfolio, basically across sterling fixed income. So how did I get to be here? Actually, I think I've got quite an interesting CV that gives me some different angles on some of the things that have been going on in the market over the last year in particular. So before I joined the PPF 3.5 years ago, I worked at BlackRock as an LDi portfolio manager. So I've seen things from the asset manager side as well as the asset owner side. And before moving to BlackRock, I spent most of my career working on the sell side, so market making, interest rate and inflation-linked products for HSBC. So I've been trading UK government bonds for 20 and a bit years, and this has definitely been the most interesting year of those 20. And yeah, as I say, kind of that background on the sell side as well as the asset manager side, and now as an asset owner, I think has given me some, a bit more of an insight into some of the things that go on in the different pockets of the market.
Oh, thanks for that intro. And I guess my first question is, why does the PPF need to get involved in LDI in the leveraged sense of LDI. But before I do that, there's a question already, and I think that's from Chris Flood. So I'm going to ask, is that you accidentally, Chris?
Yeah, sorry, Henry, I didn't mean to interrupt you. I was thinking of I was trying to think of how to put a question in a question box. Or you carry on, please.
No. Okay, well, I'll overrule you there, Chris, and we'll come back to that question. Why would the PPF want to get involved in leveraged LDI, as we call it, as opposed to the sort of John Ralphian Boots version?
Yeah, sure. So why don't I take a step back and start with what I think LDI is. So I think it's used quite interchangeably to mean a number of different things. So from a product to a strategy. But for me, the starting point for LDI is that it's really a risk framework that looks at, rather than just looking at the asset side of the balance sheet, looks at the holistic risks on the whole balance sheet, and then tries to come up with an investment strategy that relates to both of those. So kind of the starting point, obviously, for us is thinking about the rates and inflation risk that we have on the liability side of our balance sheet. For us, and pretty much every pension scheme, that's going to be the largest risk that we run if we just invest in cash, say, if we didn't do anything about it. And we take a view that interest rates and inflation risk is a risk that we're not rewarded for taking. So whether if we don't hedge our interest rate risk, we don't think that's going to generate us any extra returns. So therefore, it's a risk that we want to be hedging. And that allows us to use up more of our risk budget to invest in other assets that generate returns. So we think there's therefore a place for an LDI portfolio, which is essentially what I manage, which is then kind of buying the assets that match up with the behaviour of the liability. So giving us interest rate and inflation risk in the UK. So we hedge all of our, as I say, we hedge all of our interest rate and inflation risk. And the reason, I guess, that we use leverage within that strategy is that we're trying to do two things. So firstly, we want our investment strategy to allow us to continue to grow our excess reserves. So that's the reserves that we keep against either some adverse changes on the actuarial side or more likely schemes falling into the PPF. So we can't just sit here and be fully funded against the schemes that have already transitioned into the PPF. We need a buffer against the possibility that more companies default and they have pension schemes that are underfunded and present additional claims. So we're trying to do two things. We want to hedge all of our interest rate and inflation risk because we think that's an unrewarded risk. But we also need to have some assets invested in return-seeking asset classes that are going to generate some extra returns to help us build up that buffer of reserves to be able to meet future claims. And the way that we can kind of square that circle is by using leverage. So roughly speaking, we have just over 50% of our assets invested in liability hedging assets. So whether that's in the LDI portfolio, so kind of the common and garden gilts, interest rate swaps. We also have quite a chunky allocation to what we call hybrid assets, which kind of sit within the two camps of interest rate hedging, but also generating returns, which effectively is sterling corporate bonds. So when we're thinking about how much leverage we want to use in the portfolio to allow us to meet those twin objectives of growing reserves, but also hedging our interest rate and inflation risk, we're thinking also about, well, how much liquidity risk are we willing to take? Now, I don't want to sound like there's a benefit of hindsight highlighting these risks. This has been a core part of how we've determined our allocation to the LDI strategy and how much leverage we want to run in the LDI strategy since really the LDI strategy was set up here. So there's a question for really for the board to kind of play off these different risks. So the risk that we suffer a deterioration in our reserves as a result of being unhedged in interest rates and inflation, zero tolerance or zero appetite to run that risk. What's our appetite to run a risk that we don't have enough reserves if we get more schemes falling into the PPF in the future? And what's our appetite to run liquidity risk? And we've obviously seen some of the consequences that can be felt of running liquidity risk. And really, I think the question around that latter part, there's probably there's obviously a number of components, but I think two of the key ones that we think about there are, kind of how far do we think the market can move, but how far do we think the market can move in the time it takes us to react and reshape our portfolio. So for us, we're in a really strong position. We manage all of the LDI strategy in-house, and we have a very strong in-house team overseeing the rest of the assets. So we're able to make decisions really quickly. And maybe if I talk a bit more about how we manage the strategy, effectively we're running it in a real time basis. So we've always got a really clear picture of how much liquidity we've got left in terms of running the portfolio. So we can react really quickly. So I would say probably relative to other schemes, we should probably be more willing to run liquidity risk than others because we can react very quickly. We've also got a lot of levers that we can pull in terms of other asset classes that we can use to raise additional cash for the LDI portfolio. And with all that said, kind of our starting point, even kind of going into this period at the start of this year, was probably more conservative than most schemes. We started off thinking that we needed a buffer of probably more than 200 basis points worth of rate moves before we ran out of immediately available collateral in the LDI portfolio. And as I say, that's in the context of being able to change our broader asset allocation very quickly. But maybe I'll stop there. I've covered a lot of ground and probably thought on a bit too much, sorry, Henry.
Well, thank you very much. And 200 basis points worth of buffer. I bet you there's an awful lot of pension schemes that could have done with that over the last couple of months. So that sounds good news. I've got a couple of questions which I do want to take.
Yeah.
There's this sort of ongoing Chris Flood question. Now, Chris, do you want to ask it now? Are you there? Chris, do you want to ask?
Yes, Henry. So I really don't mean to interrupt your flow. I mean, it's not fair for me to jump in because. So you carry on, and I do have questions. Yes.
Well, I mean, now's a good time to ask a question.
Okay. Well, I mean, does the PPF think that there really was excessive leverage in the LDI funds? Because I mean, all of the LDI managers and really the regulators really wanted to try and blame the violence of the move in the gilt market for what happened. Do we actually think that LDI funds are actually safer? Yes, the buffers have increased, but there are still highly leveraged elements within the restructured LDI funds. So I mean, there's still some parts of the LDI funds I understand are running with relatively high levels of leverage as well. So that would be my question.
Sure. I guess I probably don't want to get too far into criticising some of my previous colleagues and indeed their peers, but I think you're right to say that the kind of the systemic position of LDI funds LDI strategies being leveraged, and I think scheme decision making being probably relatively slow. I don't think anything's fundamentally changed there. What's changed is the point at which a rising gilt yields would trigger another one of these rush for liquidity and deleveraging. So I think, as I say, kind of putting that in the context of our strategy, we think the thing that works well for us is that we've got a trigger at which point it prompts us to kind of do something, and for us that was further away from market rates than perhaps most of the rest of the LDI universe. People probably on that front are a bit more in line with us in terms of like where their portfolio is now in terms of leverage. But I'm not sure that things have changed dramatically from an underlying scheme decision making process, and indeed the kind of the other assets that they hold that changes. So if we get into another environment where yields start rising, are some of these LDI board funds and their asset managers going to be going out to schemes earlier on to say, look, we think we need to increase leverage here? That piece I'm not certain about, and I guess by that I mean kind of the way in which a lot of these pooled funds work in my experience is that they have mechanical triggers at which point they go out to their underlying investors and say, we'd like some more capital, please. And then they have another trigger that says, okay, it's too late to put more capital in. We're just going to have to liquidate the leveraged exposure. I don't know whether those triggers have moved. I would hope that they have. But it's not clear to me whether they have moved. And I think even less likely is the kind of the changing governance and changing asset allocation of themes when that call comes in from the asset manager to say we need some more capital to go into the LDI portfolio or into the pooled funds. Are they able to make those decisions quickly? And really for me that probably means pre-making those decisions in advance and being prepared for when they come.
A kind of related question is that we're not actually sure of the scale of the collateral calls that happened across the sector as a whole yet. So we don't actually understand fully how much the actual liquid assets have decreased across the sector, and we don't really understand, I think, how the collateral liquidity ladders might effectively have been restructured, and how these might actually be affected by the sales of the liquid assets that have gone already. If it is the case that illiquids or harder to sell assets are a bigger proportion of the assets of the pension fund, does that effectively mean that they have potentially less room for manoeuvre, even if they are operating with these bigger safety buffers?
Yeah, so I mean that's definitely one of the concerns I have, and I think a reason why the impact of what happened in September and October is going to kind of continue to reverberate around asset markets for I don't know, maybe another 6 to 9 months. I mean, I think the most obvious anecdotal example of that is what's happened to some of the institutional property funds. We obviously went through a period which seemed like every day an asset manager announced that their property fund was being gated for withdrawals into next year. And I think that's just symptomatic of exactly that point that you just raised, that when schemes have been trying to raise additional capital to de-lever their LDI strategy, they've been doing it from liquid assets. So we've kind of seen the most obvious the most obvious impact of those probably in credit markets. But the next stage is going to be kind of you've rebuffered up or recollateralized the LDI portfolio. Well, now you need to buffer up kind of the next link in the chain, which is your liquid assets. That if you do get another call for liquidity from the LDI strategy, you need to have assets that you can sell relatively quickly. And this is not, I guess this is not just about September and October. We had a round of kind of a pre-warning of this in June. We know a lot of the LDI pooled funds recapitalised in June, so went out to their underlying clients to ask for capital. So we've had two fairly decent rounds of deleveraging. So even for those schemes that didn't perhaps end up losing their hedges in either June or September, if we get another surge in yield and another call for capital to delever LDI pooled funds, they might well have used up all of the liquid assets that they had left available, and they're either going to be taking big haircuts on some of the private assets that they hold, or they're just going to lose their exposure. So as I say, I think that long-winded way of saying that yes, you're right, that stock of liquid assets has reduced, and I think the next stage of the impact is people are going to be trying to sell or reduce some of their holdings of private assets to try and top up some of these more liquid assets.
Thank you.
Thanks very much, Chris. I'm going to move now to Barry. I think you've had your hand up longest, and I'm aware that there's a queue behind you, Barry, of John and Con. So be aware, everyone, there's thick and fast. These questions are coming at you, and we haven't even got to what you've actually done. We want to know about that as well. So Barry.
Thank you. My question might seem a silly question, but I'm going to ask it anyway. You say that you wanted to manage interest rate risk, and you explain that was a balance sheet risk because it's not really a risk to the pensions being paid to them themselves. And I just wondered, why did the PPF feel it has to manage the balance sheet in that way at all? Sure.
Well, I guess the starting point for us is probably that we're a bit different to most pension schemes. So we don't have a sponsor. So if things go wrong with our investment strategy, we haven't got an underlying sponsor that we can turn around to and say, actually, we need a bit of extra cash, please, to plug the gap. So we need to be able to stand on our own 2 feet, and our key performance metric is the probability that that we do have enough assets to meet all current claims and all future claims. So obviously, the more risk we introduce onto the balance sheet, the greater the chance that at some point in the future, asset markets move against us, and we find that from a balance sheet perspective, we have fewer assets than we have future liabilities. In which case, let's say we're going to be sitting there, worried about how we're going to meet those claims in the future. And certainly, if I was a member of the PPF and looking forward to receiving my reduced pension, I'd be pretty worried looking at the PPF balance sheet and seeing that it didn't have enough assets to meet its future obligations.
Are you comfortable, John? Barry, do you want me to move on, or you've got
No,
a
I'm not entirely comfortable, but do move on because I might become more comfortable as this
suspect
dialogue
that
unfolds.
we have got more questions on the same theme about what you're doing with LDI and your balance sheet. Is it really important? But I'm moving on to John, who's already unmuted yourself. Thank you, John. Do you want to ask your question?
Thank you. Yeah, I mean, just closing on that previous comments, I find it curious that you think you don't have a sponsor. I think we, the rest of the pension schemes, think we ultimately underpin the PPF because you've always got the ability to immediately charge a levy. So I think you do have, to some extent, the whole of the UK economy as a sponsor. But the questions I had was kind of twofold. I mean, I'm greatly comforted by what you've said, evident and how you presented yourself, and take a lot of assurance that the PPF has got the expertise in-house to manage this stuff. I think that's really, really important and helpful. I guess my question is, you said you had a 200 basis point buffer back at the start of the year, the course of the year. I've got really two. The first question is, where would you assess from your internal perspective what that buffer should be now, in terms of, if you're going to simplify it to a basis point comparative?
Yeah, sure. So I mean, I guess the answer is it needs to be higher. So sorry, when I said we had a 200 basis points buffer at the start of the year, actually I meant our internal rules we needed a minimum of 200 basis points. Actually, right. we had much more than that. Yeah, look, I think the answer is, the experience of September and October is that the market can move more quickly than more quickly than we previously anticipated. So that 200 basis point minimum number probably needs to be a bit higher than it was. Than it was. But obviously we've had days where markets move 30-40 basis points in a single day, and even if we're able to raise collateral in extremis, from other asset classes in 3 days, actually 200 basis points sounds a bit sailing a bit close to the wind if the market's moving 50 basis points a day. I think 200 basis points is still probably okay, but I think it probably needs to be a bit closer to 300. As I say, I think you kind of have to recognise the fact.
And the follow-up question, I took a lot of comfort from. You noted that you were in a strong position. I think it's really important you've got it's all in house. You've got complete control of your assets in terms of how quickly to liquidate and quick decision making. But if you try and expose that to the system as a whole, if you have slow decision making trustees with outsourced assets, etc., so you've got the people which effectively you insure are not as capable as you are structurally able to make quick decisions. How much of a buffer should they have had in basis points?
I'll probably get in trouble if I start making recommendations to what our members should be doing. But I think the implication, as you say, is pretty clear that if we thought the minimum level of liquidity is 200 basis points, and we can change our investment strategy if we need to in 2 or 3 days. If schemes have got a decision-making process that's a lot slower than that, then they need to have a much bigger buffer.
Yeah, and there's the obvious question at the end of all this is, did anyone tell the schemes that? But let's. I think that's why we're in the situation we're in.
Yeah,
that's not for you. You've got a remit to manage the PPF, which you've done well. But I'm just for those who don't control their own assets, don't have in-house expertise, don't have quick decision making. certainly 200 basis points is proven not to be sufficient, but okay. So you're on mute, Henry.
Sorry about that. Con, be careful with Con, Evan. He's liable to fall off his chair if you're too violent with him.
I'm still in a great deal of pain from that exercise, by the way, so I'm none too smart today. Evan, the question I wanted to ask focuses on the way in which buffers are calculated, and indeed what assets are held within the so-called buffer. The point I would make is this: the events which led to the LDI spiral were actually rather modest. The movement in conventionals, using the 15-year as a proxy for the duration of UK closed DB schemes, which are where most LDI is done, that moved 2.5 percentage points down in price, around 20 basis points in yield on the day of the Bank of England bank rate and QE sales disclosure. It then moved by another 2.5% down in price the next day, and that was sufficient to have pooled funds rebalancing. It was also sufficient that by Friday morning we saw the sales of other gilts in the markets. Now, everyone has been saying that they are carrying buffers of 100 basis points or so. Now, what's actually triggered this action in markets is a move which is far lower than 100 basis points. And I'm wondering if the nature of that problem is that the buffer evaluations and the 100 basis point moves don't in fact take consideration of market dynamics into the modeling. In other words, that what's being done is an exercise in comparative statics, whereas what should be considered is the dynamics, and specifically the dynamics of collateral calls on the scale that we see with LDI being so widely adopted. It seems to me that the initiation for that, we know that 37 basis points was sufficient to trigger that spiral this time. One wonders what the initiation point might be otherwise. That's I think the really serious question to be addressed by the industry at large here. Excuse me for a second. The second point I wanted to try to gain some insight into is the nature of the assets being held for buffer purposes. Are these bills? Are these deposits? And what order of magnitude of return penalty is being incurred by holding buffers at 2 percentage point shifts, 3 percentage point shifts? I mean, a 3 percentage point shift for most pension schemes is order of magnitude 30% of assets. Yeah, those are the questions, and they're very poorly framed. But I'm none too swift this morning because I'm spiked out of my mind on morphine.
Well, sorry to hear that, Con, and I hope you're feeling better.
Thanks, Evan.
Soon. So maybe I'll try and break those up a little bit. So maybe I'll start with I suppose the structural question on how are collateral buffers calculated. And I guess you're right. The way in which schemes, and indeed we think about it is that as though the shocks in market rates are an entirely exogenous factor. So as opposed to if the market moves, does that then prompt other moves? Well, we're just thinking about the total amount the market can move before we get to the point of running out of collateral. And to be honest, I think for an individual scheme perspective, and even for us, it's quite difficult. It would be quite difficult to make that leap from thinking that rises in market rates are simply an exogenous thing that happen, as opposed to an endogenous process that LDi is part of, because the only view that we have of how much leverage there is how much leverage we've got. And that was a point that came up in the select committee a number of times, that there's just a lack of information about how much leverage is being run across the whole scheme universe. I think, but as I say, I think without that, it'd be very difficult to make that leap from exogenous to endogenous process. I guess the point around the 37 basis points probably feeds back a little bit into the conversation that we were just having about the speed of being able to raise cash. So for sure, over the course of those 2 days, the market obviously moved 37 basis points higher. I kind of view that as, describe it as the straw that broke the camel's back. We were already 40 basis points higher in long dated yields in September by the time we got to the Bank of England meeting, and that was after yields having risen 80 basis points in August. And as I say, by then we'd already had one round in June where asset managers with their portfolio clients had gone out to say, please can we have some more collateral. So maybe the concern is that point at which asset managers, or indeed asset owners, are looking at their investment strategy and saying, well, actually, we should be starting to get a bit nervous about how much collateral we've got left, and doing something about it. That should have happened earlier, perhaps. And then when you get this 40 basis point shock, that's not enough then to trigger a round of forced deleveraging, which obviously is ultimately what happens. So I guess I suppose thinking about our portfolio, we have been reallocating assets out of other asset classes into the LDi portfolio through the first half of the year, certainly into June, when yields were starting to rise, to make sure that we did maintain the level of liquidity that we thought we needed, and then some. So we kind of went into that position. We went into that September period, I would say in a good place. Whereas, particularly pooled fund clients, if they've been called for collateral from some of their liquid asset classes in June, it's pretty unlikely I would have thought that they would have topped those up and then have been in a position in September when another collateral call would come in to meet this. And ultimately, that's kind of how it played out.
Yeah, so, I'll offer you a little bit of insight there. One of the things which has been told to me, so it's anecdotal rather than anything else, is that the calls back earlier in the year were met as to about 90% level, given that they're voluntary, and that's but apparently in this round that number was closer to 50 or 60. So the schemes either didn't have the money or just weren't prepared to do it, but it made a big difference this time around. Added, if you like, a second wave to the rebalancing.
Yeah, and if we had another round in, let's hope we don't, but if we had another similar round in December,
I think you'd be lucky to get any.
Yeah.
Thanks. That's really sorry. Cost of this stuff.
Sorry. So in terms of what assets we think about that form part of our collateral buffer, I guess the biggest part is gilts. So for us, under a number of our derivative agreements, we can still post gilts directly as collateral.
No problems with valuations there.
No.
I mean, if you're posting securities rather than cash, the obvious argument is, I think the price is lower than you do.
Well, so for gilts, we didn't have any problems. I guess the benefit.
That's extremely good news.
Yeah. So I guess the benefit that we have for gilts is that we have almost an official close in the form of the TradeWeb closing prices every day. I'm not sure off the top of my head actually, but I think in most cases we reference in our derivatives agreements a process. Well, we definitely we definitely explicitly say in our derivatives agreements a process for where prices come from, and if there's a dispute about the value of securities, how you resolve those.
For gilts, you've got TradeWeb the next day.
TradeWeb, we've got TradeWeb, and we take haircuts on the gilts that we post as margins. So those are all kind of pre-agreed beforehand. So the banks do have some comfort that they, that they are over collateralized.
So your contracts all call for daily collateral calls rather than the 4 times possible with centrally cleared.
No, so we do have some centrally cleared swaps as well. It's a relatively small part of our portfolio, probably around about less than 5% of our total swap portfolio is centrally cleared. But you're right, for those in extremis, the CCP can call for additional margin for 4 times a day. That didn't happen during September and October. Perhaps it's worth mentioning that. So for us, so we keep a large stock of gilts that we can post as margin under some of our derivatives agreements. We keep a reasonably large amount of cash invested in overnight money market funds, so which we've got T+0 liquidity. So if we had to meet intraday calls, whether it's from the CCP or indeed from any of our other derivative counterparties, we could turn around to those T+0 money market funds. We also have I think 7.5% of the fund is invested in cash that again we manage in-house. So kind of replicating the strategies that some of these money market funds use. So I mean that's your short-dated corporate bonds, T-bills, not just in sterling markets, but in overseas markets as well, CDs, CP, those kind of
okay. It's fantastic. Thank you.
Maybe it's worth noting. I think you talked a lot, or you mentioned already this morning, kind of this idea of rate rises being endemic and kind of systematic risk. The systematic risk that I was worried about was really kind of comes from central clearing and pension schemes being forced to post a cash margin, but having a portfolio of gilts. And the market actually that I thought would come under stress was the gilt repo market, where you'd have a rush of schemes being called for cash margin and having to convert their gilts into cash by using the repo market. Actually, that performed probably better than I would have expected in an environment where yields obviously rose pretty sharply over a short period of time.
I do know schemes that weren't able to roll over repos, by the way. Yeah, the repo costs was just excessive for them. Yeah. Anyway, thank you. Let's let everyone else get involved.
Yeah, thank you very much, Evan. That was such an interesting insight for those of us on the other side who simply don't have your experience, and gives us an opportunity to think a lot about what this problem looks like for schemes in the future. I see we've got another question from Rodrigo. I'm going to ask that question. I then want to ask a little bit more about your experience after that. So, Rodrigo, do you want to unmute and ask your question?
Sure. Thank you very much for that. So, firstly, I mean, I come from a viewpoint that just to sort of introduce where my thought process is before I ask this question. So, I come from the viewpoint that leverage in LDI is not necessarily inherently a bad thing, and I know it's been a lot in the press and been debated a lot. But I guess the issue that arose in September was sort of more of a combination of extreme events, political crisis, and the fact that ultimately we're in a brand new macroeconomic and new volatility regime. So I guess there was some points around stress tests and whether they should be forward-looking or backward-looking. And I guess to an extent, from all I've seen so far is that most managers have potentially moved to somewhat of a kind of a VAR model as opposed to having static stress tests. But there were some signs, if you followed, say, the vol market, for example, if you looked at where options in sterling interest rate swaps were pricing volatility in the run-up to September, those volatilities had sort of tripled and probably quadrupled by the end of the crisis, but that was after knowing what was happening. So I was wondering if there's any view to perhaps look at more forward-looking indicators. So that was kind of part of a question that, following on from Con Keating's questions that kind of came to mind. That was kind of first thought. And I know, I guess, to me, it was quite clear that hearing you talk, Evan, that obviously the PPF are very sophisticated, run everything in-house, and they're able to react in a very fast manner. So I'm not sure if this is directly a question for you, but just more of a general question. That then obviously the issue arose more with pooled funds and smaller clients that weren't able to, smaller pension fund clients of those pooled funds across the manager space that weren't able to react as quickly. And we talked about some of those that collateral had already been used up in the run up. But even then, it was the speed of everything and the operational issues. And so I guess looking at some of your indices that you've published at the PPF and showing funding levels have drastically improved, what I'm worried about is, yes, funding ratios have improved, but maybe for some of those smaller schemes, hedge levels have decreased during that liquidation phase. And I don't really have any way that how to collate that data. I've kind of been just trying to sort of have ad hoc conversations with people, but I guess it'll be interesting to hear views generally about how potentially smaller pension funds that are in those pooled funds that had to liquidate some of those hedges, how have those hedge ratios changed? And we have seen a snapback lower in real yields from those high levels of 30-year real yields got to 2.5% just before the Bank of England intervened. So if there are any liquidations around that period of 2%, 2.5% of real yields that are now down at zero again, those for the smaller funds, it seems like those hedge ratios probably would have been lower, and potentially the funding ratios wouldn't necessarily be as good as the aggregate schemes for the larger, more sophisticated schemes that were able to react quicker, like yourselves are in a very strong position. So, you know, I'm just wondering what thoughts are around how can they now actually come back and put those hedges back on again if they can't run the leverage that they could before, don't necessarily have the assets liquidated at the worst level. How does that look for those types of schemes? Sorry, long questions, but
that's cool. So I guess probably a fairly short answer to the question about forward-looking vol. So the way in which we run our stress tests is a combination of our model as well as these static shocks that essentially are a judgment. The idea of using forward-looking measures of vol and using swaption price is something that we discussed. But we haven't worked out A, whether it's a sensible idea, or B, how we might do it in practice. But I think for particularly if you're looking at shorter dated shocks, then probably the swaption market can be quite useful. You know, pricing of 1 month or 3 month swaption kind of can help to put a value on the liquidity risk that you're running, and tell you the probability that you end up simply running out of collateral, and how much that would cost. But as I say, so far we haven't really got any further than talking about whether it's a good idea and how we might do it. But I think it's probably it'd be something that'd be sensible to add to the toolkit to say, you know, the environment we got into where the market was pricing volatility, I don't know, 3-4 times the kind of the daily average. That should be a flag to say, hang on a minute, maybe we need to think about whether we've got enough liquidity. So even if you're not incorporating it directly into your framework as a rule, at least something as a flag to say, you know, we need to have a look at what we're doing. Second part of the question, I share your concerns, and one of the things that I would say us as an institution have been quite keen to do when we've been talking to, I guess, other stakeholders in our world is exactly this point, that the 700-800 index says that funding ratios have got better, and I think it would be very easy for you know, whether it's DWP, Bank of England, or the government to say everything's all right now. Funding ratios for schemes are better. The bankers, between the bank and the government, they've sorted out the triggers that drove gilt yields higher. Pension funds have rebuilt the buffers. Everything's okay now. But that misses out this tail of schemes that, you know, Con said anecdotally that maybe 50% of schemes weren't able to put capital in to maintain their interest rate and inflation exposure, and as you say, exactly at the wrong time, exactly at the time where, if anything, they should have been looking to increase their interest rate and inflation hedging. How big that problem's going to be, unfortunately, I don't think we're going to find out until we start getting the annual accounts for some of these schemes over the course of, I guess, the next 18 months or so. But just looking at the Bank of England's own portfolio of long-dated gilts and linkers, I think I calculated the mark-to-market of sort of profit that the bank had made at £6 billion on Friday. So that's definitely £6 billion that pension schemes have lost. And obviously, the Bank of England, haven't bought everything that was sold by pension schemes. So I think you could probably easily double that number in terms of the amount of money that's been lost by schemes that ended up losing their hedges. And I guess the question is, how widely has that pain been shared? And unfortunately, I suspect that the answer is not very widely, but that number is going to be concentrated in a relatively small number of schemes that are going to take in a material funding hit. And with my PPF hat on, it's that tail of schemes that have a big deficit that we're most concerned with. So even if our overall universe has improved, I think, to be honest, this period is going to have been a negative one for our balance sheet risk in terms of some of these underfunded schemes potentially needing to need a top up from our reserves.
One thing that does strike me from what you said, Evan, is this 200 basis points number. Was this something that you were discussing with the pension regulator? I mean, was the pension regulator happy with 200 basis points? Were they suggesting that 200 basis points was the right sort of buffer for other schemes that they were regulating? Or was this unique to you? I mean, it's a number that I don't think anyone else recognises as being out there in the market.
Sure. So we're in a bit of a weird legal limbo. So we're not actually regulated by TPR. So we do interact with them on a fairly regular basis, probably at a more senior level than me. I'm afraid I don't know whether we discussed that. Yeah, we discussed that number with them, but so I think for us the key was really about having a trigger earlier on to say, do we need to do something? And sometimes when we hit that trigger, the answer might be actually we don't need to do anything because we're not concerned about the market moving more quickly, or we've got kind of some planned changes to asset allocation that are likely to come through and improve that number. But at the very least, it should be an earlier prompt to have that discussion. And to say that's in the context of us being able to move relatively quickly if we need to.
And you presumably know what the reduction in the yield on the overall growth of the scheme was for having that buffer, and you were able to justify it internally, yeah.
To be honest, we probably don't really think about it too much like in that way, because it's something that we just have to have. So it's not it's not like the kind of weighing up pros and cons of how is this going to impact the growth of reserves. Like we have to have. Yeah, it's
just part and parcel. And okay, so this sort of leads me back into the central question, which is what actually happened this year? How has 2022 been for an LDI manager of the PPF?
Yeah, probably less stressful than if I was still an asset manager, to be honest. Yeah, it's been an exciting year. We obviously started the year with long dated 30-year gilt yields below 1%, and we got up to a peak of 5% in the summer. I mean, I guess these large market moves aren't just confined to the UK market. We've had a fairly dramatic change in central bank rhetoric through the course of the year. From I guess kind of go back to maybe Q3 last year. I think central banks were still reasonably convinced that inflation was going to prove transitory, and that they weren't going to need to do much more than take rates above neutral, which for the Bank of England, I think back then they probably thought neutral was about 1.5%. So we've had a fairly dramatic change in the underlying macroeconomic environment, with inflation obviously continuing to zoom higher, in part as a result of energy prices, but I think also in part because inflation expectations have have moved higher and become a bit more entrenched in wage negotiations. We've had central banks kind of react to that by swinging from trying to keep rates relatively loose to maintain growth to now thinking that their only goal is getting inflation back to target. And as part of that, I think the big change for the UK has been the end of QE and the start of well, now active sales by the bank. So we've had a period of probably 12, 14 years where nearly every piece of net issuance from the government has been bought by the Bank of England or by LDI schemes de-risking. So we've kind of got used to a pretty benign environment for government issuance. So the central bank has turned from buyer to seller, and kind of judging by the level of hedging that we see, we're getting somewhere towards the peak of LDI de-risking. And obviously, even before we had this episode, which I think makes people understandably less keen to use LDI strategies, and particularly leveraged LDI strategies. So we've had a massive change in terms of the macro fundamentals and a massive change in terms of the supply-demand dynamics in the gilt market. And I think with most market participants, particularly on the sell side, probably having only experienced the environment of the last 10 years where whatever bonds you buy from the DMO or bonds you buy from investors, we've probably only got to wait a week and you'll be able to sell them back to the Bank of England again. So I think that environment has been quite difficult for market makers to.
How's it been for you, Evan?
How's it been for me?
We're really interested in your experience.
Sure. So it's to be honest, it's been, I would say that the best thing I can say about our experience this year is that it's pretty much been business as usual every day. So even during that week in September and October, the end of September, where we got called for £1.5 billion of collateral in less than a week, actually it was still pretty much business as usual. Yes, we did a bit more repo every day than we normally did, and we definitely had to be a bit more on top of what was going on a real-time basis. So rather than being reactive and coming in each morning and saying, what's our collateral call? 10 million, we've got plenty of cash for that, nothing to do. We were sitting down at lunchtime the previous day saying, okay, gilts have sold off 30, what's our collateral call going to be tomorrow? Right, we need to raise another £100 million of cash for tomorrow. So it's definitely a much more fevered state of activity during that 6-week period. But as I say, it was still relatively business as usual in that we're only doing a couple of repos every day to top up our cash buffers. Broadly through the year, I suppose we probably had more questions. So whether it's from the likes of yourselves or journalists or members of our investment committee or our board, we've had more. There's definitely been a lot more focus. Like the last, all the previous years I've been doing LDI, it's been the boring bit of the portfolio that nobody really wants to talk about, and normally there's not really very much to talk about. Well, that's definitely come to an end. So there's a lot more scrutiny and a lot more questions being asked exactly around some of these topics, as I say, internally and from our investment committee. To be honest, gives me comfort that people are on top of what's going on and knowing what the right questions that they need to ask. It's been a stressful year, but I guess at the same time there's also been opportunities. So I'd say if anything, during September and October, where some schemes were obviously rushing to try and raise collateral, actually we were in a fortunate position where we were able to look for opportunities and say, actually, some of these assets look like they're trading at relatively depressed prices. That there's probably an opportunity for us to increase our allocation.
And did you, in retrospect, we've been having this conversation with the knowledge of what was to come back in February or March, would you have done things differently? Would you have reduced your leverage?
Yeah. So I talked earlier about viewing interest rates and inflation risks as an unrewarded risk, and it's probably not very popular within the LDI world, but I think it's reasonable to have a different view to that. That if when interest rates were at 3/4 at the end of last year, if somebody had wanted to say, well, actually, I have a really high conviction that interest rates are going to be much higher by the end of 2022, and therefore we should reduce our interest rate hedge, because we think it's actually it's not an unrewarded risk. It's a risk where you are going to get paid because yields are going to rise. I think that would have been a reasonable point of view at the end of last year. As I say, I'm not sure that's necessarily popular amongst my peers, but for me, kind of coming back to where I started, LDI is about making sure that you're taking the right amount of risk in the right places. And some people might say, right, I think equity's going to go up 20% this year. Let's load up our allocation to equities. I might disagree with that, but it's not an unreasonable position to have, and I think it wouldn't have been an unreasonable position to have had at the end of last year to say, well, actually, I think yields are going to zoom higher, and therefore the returns from having hedged all our interest rates and inflation is going to be a drag on fund performance. Let's dial down rates. So I think that's probably the one thing I look back to at the end of last year. It is something that we talked about and kind of what our outlook was for interest rates through the course of 2022. We probably had a view that rates were more likely to rise than fall. Could we have done more to monetize that view by tweaking the LDI strategy? Yeah, as I say, that's probably the one thing I look back and say, well, maybe we should be going to investment committee and saying, actually, I think we need to reduce our hedge. I'm not saying we would have thrown LDI out the window, but maybe it just would have meant taking a small amount of incremental risk within the strategy.
I was very pleased to hear you sort of having that view. It's interesting looking back, but more schemes weren't wondering, well, maybe 2022 is the year. Do you have any understanding whether the market in general had that conversation? Were people LDI managers having that conversation with their trustees, or was there just a sort of well, let's see if we can bring it another year?
Yeah, I can't say that I've heard anybody that did have those conversations, but it doesn't mean that those conversations weren't going on.
Yeah, Con, do you want to unmute, old boy? I think we're going to come back to you, Con, when you've actually unmuted. Has anyone else got a question while Con's actually going through that process? Okay, I have one further question. Sorry.
I think we can hear him now. We can hear him now.
I am now unmuted. No, I'm sorry. I'm shaking so badly I can't control a mouse very effectively. I really am whacked out of it today. I was just going to offer a couple of insights. With respect to Henry's question as to what the market was doing, from the analysis that we've been able to source and the data we've got, repo by the pensions world maxed in late March, and the level of interest rate swap exposure maxed in April. So I think that gives us some insight into where the market was this year or the earlier of this year there. The second point that I would like to make is people are taking great comfort in the funding ratio. There's a very elementary statistical caution to be had. Ordinarily, the confidence interval, one standard deviation confidence interval on the funding ratio lies between 3 and 4%. So, a ratio of 100% is plus or minus 3 or 4%. At the end of September, that one standard deviation confidence interval, because of the volatility of markets, was plus or minus 10 to 12%. We had a single day in September where liability values varied by £181 billion for the market overall. We have to be very careful about making any precise statements. To be confident that funding ratios have improved, you would need them to have improved by more than 10%. And the only schemes I have seen where that can be claimed with any degree of confidence are those that weren't doing LDI. Just some comments. I think Evan's descriptions of things has been very fair, and yeah, I think you're extremely fortunate. I'll leave it there.
Well, I wouldn't say fortunate. I'd say we have a well-designed investment strategy that prepares us for these scenarios. But
no, I'd agree with that. That I would certainly agree with.
Evan, this is your chance to sum up, really, because we're at the end of our hour. I think we could easily go on another hour, but we can't. So do you want to sort of like say your final bit, and we'll then sort of wrap things up?
Yeah, sure. Maybe I'll just come back to John, because he's asked a question following up from my comment about reducing hedging and increasing an allocation to equities, about whether it's hedging or speculation. And I guess the answer to that is kind of we've got, as I said at the start, we've kind of got twin goals in the investment strategy. One is kind of trying to hedge our interest rate and inflation risk and manage the volatility of our balance sheet. But the second part is trying to generate extra returns to increase the size of those reserves. So in the context of those two, and I guess trying to increase the size of those reserves, we have a risk budget which we can allocate across different asset classes. My suggestion was, well, actually, could we have allocated some of that risk budget to being underweight interest rates and inflation? I think we probably could do. I guess is that goal of investing in return generating assets to grow our reserves? Yeah, it could sound like speculation or betting, but yeah, ultimately that's investing in assets to try and boost returns in the portfolio, which I think is part of our core objective.
Your body language, John, suggests you're not entirely comfortable with that.
No, I think that makes sense from an investment perspective and the PPF perspective. I'm just pondering over the difficulty of trustees who, under sort of various funding codes, find it very difficult to re-risk. Having taken out of equities, they'd be under pressure from the regulator if they said we're going to reduce our LDI and go into equities. Just a challenge for trustees to do that from a legal perspective would be difficult, although I think it makes perfect sense what Evan has said from an investment perspective.
Yeah, no,
I think. Sorry, Evan.
That's right. Yeah, it's a fair point, John. I kind of tried to think about it from an isolated investment decision for us, rather than rather than I suppose schemes are perhaps a bit more constrained by the regulator as to what they can do.
I think there's been a number of things that have come out of today, which I want to sort of go away and think about. And it's been really great to have you as a practitioner with the unique circumstances that the PPF find itself in, talking to us as a self-investor in LDI. It's great to hear you talk so frankly, not just about the things that went right, but also about the difficulties that you may have encountered along the way and the way in which you met those issues. And it's good too to hear that there is an alternative way of thinking about buffers and so on, as you've articulated. In all these things, it's great to have this discussion, and I'm really proud we're having it on the Pension Playpen. If we can all virtually give Evan a big Pension Playpen round of applause, I'll hand back to Steve. Okay, Steve,
there you go, Evan. A virtual round of applause. So how about this? There you go, you can hear that. There we go. So there we are. So, Evan, fantastic input, and as Henry says, I really appreciate your openness and frankness on your strategy and your style and what's been good and what's been bad. Let's learn from that. The video will be up on the Pension Playpen website this afternoon. If you're not a Pension Playpen member, then please join, and we'd love you to be a part of the group. A few dates of your diary. Our Christmas drinks is on the 19th of December at Ludgate Circus at the Albion in Ludgate Circus. So if you're in London or an hour's train journey from London, please come to the Christmas drinks. It's at the Albion at Ludgate Circus. And before you ask, it's completely free. That includes food and beer. You have to say these things, Evan, sometimes. There's some Pension Playpen members. It's completely free. So come and join us for a drink and snacks on the 19th. I think we're starting at 12:30 at the Albion at Ludgate Circus. Next Tuesday, we have Turning Pensions Upside Down. Link Group, who we all know are represent about 40% of the Australian market, of doing a white paper on turning pensions upside down. What have the Australians done? What should we be doing? And what should the UK government be doing going forward under quite a wide range of topics? So we've got a white paper, Turning Pensions Upside Down, next week. Lastly, thanks to everyone for your time today and for your questions and for your involvement, especially to Evan and Henry. And as usual, we are still saying this at the end of November. Pray for peace in the East. And hope England win tonight, unless you're Welsh. So sorry, I had to say it. But thanks everyone for your time, and really appreciate that. Take care, everyone. Thanks a lot. Bye.
Thank you.
Yeah.